We're back, and here comes Ask Annex. Got a question for us. You head to our website, annexwealth.com. Look for the Ask tab. In the studio, Fred Coleman, CFP and a wealth manager. Hey, Fred.
Hey, Danny.
And we got Matt Morzy, investment team manager, also a CFP. Hello, Matt.
Hey, Danny.
All right, question number one, big one. I'm 33, earning $120,000 a year. My employer offers options to contribute to a Roth and traditional 401k. Should I split my contribution percentages to max out both? Or am I making too much to reap the benefits of a Roth 401k? I've heard that the Roth is best when younger and making less money, but unsure on the threshold for the most benefit.
Yeah, very good question, and this is a question, probably one of the most common questions that we get, and it's a very important decision, even though, it's just a click of a button to go on that 401k website and make the adjustment. Generally speaking, Roth is beneficial for younger individuals because that's assuming that your income will go up in the future, and in turn your taxes will likely go up in the future as well. Also, the good thing about the Roth is that you just get the taxes out of the way. So that's the other argument for the Roth. You don't have to worry about it. You pay it now. You benefit from all the gains. You never have to pay it again. In order to give you a better assessment, you do need a financial plan that projects tax rates for the rest of your life. Because a lot of times there is an opportunity where your taxes will be much lower. And for many people, it's when they retire. So between the time that you retire and you have to start taking those guaranteed income sources like the required minimum distribution, that's when you usually have a time period where your taxes are single digits or sometimes even zero. So what I lean towards in these situations is the traditional, because not only can you take those tax savings that you're getting and invest it in other ways, but you also defer the option to pay taxes. So in other words, you can choose over the next 40 years until you turn 73 when you want to pay taxes. You didn't mention marriage, you didn't mention kids, and those are things that could potentially lower your taxes in the future. There also may be tax laws that are passed in the next 40 years where you'll have the opportunity to decide when you want to go ahead and do what's called a Roth conversion. You can do that at any point. It doesn't have to be with the actual initial contribution. So investing in that traditional 401k just gives you a little more flexibility. But once you put the money in a Roth, there's no going back to the traditional.
Yeah, I think this is one of the things that makes working with a partner like Annex so powerful. Being able to sit down with somebody like Fred, walk through your unique situation, use the software that we have access to in our financial planning team, and really finding something that's really customized and specific to you, I think is incredibly powerful. Being able to look, 30, 40 years down the road and going, okay, if I make this decision today, what does that look like? And what would I prefer when I'm older in order to be able to access that money? And what's going to be important to me? Obviously, we don't know all of those things now, but we could at least get ideas of what that possibility looks like. The other thing I would look at too is, are you getting an employer match, and how are they making that match? If they're putting that match into a traditional 401k, that money is going to compound. You're going to pay the taxes on that later on. It might be a good idea to have some of that money go into a Roth, just because you could balance those things out. What's really powerful in retirement is having different buckets of money in different tax shelters or different tax rules, so that you are allowed that customization that you want. And hey, this year it makes sense I pull money out of this account. Next year might make sense someplace else, or maybe I'm taking different levels out of different, but it just gives so much flexibility and freedom to you to be able to make those decisions later on in life. I think is super powerful.
If I could go back in time and talk to the 25-year-old me, I'd do a couple of things. The first is I would really say, hey, consider this Roth a whole lot more. Mm-hmm. Second, I'd punch myself in the mouth for all the dumb things I'm going to do between 25 and now, and then a whole lot more. All right, Ask Annex, our next question. Why do 401k target date plans invest so heavily in international stocks?
Yeah, that's a great question, and it's really a matter of perspective. In the U.S., just like across the world, we have what's called the home country bias, which means that wherever you live, you're generally going to invest more of your money there than you are in a lot of other places. It just comes naturally. Now, the U.S. markets right now is about 60% of the overall stock market, but that changes over time. We've had about a 15-year stretch where U.S. stocks have outperformed international stocks on a pretty consistent basis. If you go back 15 years ago, it wasn't 60-40. It was more like 50-50. And even before that, there was a time where U.S. was 40% of that market, and it fluctuates over time. So looking at that number is going to change. But what target dates are trying to do is give you a general asset allocation that's going to be flexible over time to follow what they call a glide path. which essentially is the closer and closer you get to retirement, they're going to become more and more conservative to match what they perceive to be your risk tolerance. So what they're going to do is they're going to match those allocations, shifting from stocks to bonds over time. But primarily underneath that hood, they're going to try to keep allocations somewhat consistent to a global experience or a global thing. Not because they're dealing with global investors, which they might be, but because they're trying to diversify and give you that range of outcomes that lowers risk but gives you that return. So it's going to measure somewhere pretty close to what that global market's going to look like.
Hey, running out of time, but here's a quick one. Guy's uncle was a remodeling contractor, found old stock certificates. Was going to pitch them, but then he offered them to the nephew. It's not finders keepers, is it?
No, it doesn't work like that. Those stock certificates are going to be registered to a specific person, so it's not much you'll be able to do with them.
All right. Fred Coleman, CFP Wealth Manager, Annex Wealth Management, thanks.
Thank you.
Matt Morzy, Investment Team Manager at the CFP, thank you.
Thank you.